Hi everybody, this is Gary Dean and this is our weekend video report for Monday, January 18th, 2016. Hope you guys are having a fantastic long weekend and let's get started. So, as I explained on Thursday, my expectations, or actually it was Friday morning, my expectations of a bounce that was pending was wrong, and it's not the first time and it's not going to be the last time. The only thing that I can go off of are previous times we've been at certain levels with sentiment at extreme lows and momentum at extreme lows. And to me, I mean, even though the markets got absolutely crushed on Friday, it still doesn't make this situation safer to short. You're still risking. I mean, can we go lower? Obviously, yes. But you're risking these short covering rallies, which it hasn't come yet. But it's still, the more we go down like this, the more the risk increases for that big short covering rally that could bring the S&P 100, 150 points higher and still be bearish. So as much as, yes, like I said, I was wrong in anticipating that one of these bounces was coming. It still doesn't mean that it's not coming. It's just, obviously the timepiece was off because we're just at very, very extreme, momentum is at extreme oversold levels. Everybody's bearish on the markets. We have wave counts that are looking for a bounce. We just haven't got it yet. So we made it a little bit below the August lows. They brought it back up. If the bulls don't hold that, then we could see a move down to the 1854 or possibly even down to the 1823. Now, if we take a look at some of our the other charts here, this is what I mean by we have serious bullish divergences here. We're very, very oversold. And, we went through this support area and they tried to pop back in. And as far as wave count wise, there's still 5 waves. Even though I thought it was here, we've got the pop up. Everything made sense for the rally to move anywhere up into these levels here. But obviously the market got shaken up on Thursday night after some of the overseas markets happened, and we went down. And I've said this for anybody that's new. I've always said that fear is stronger than greed, and right now there's just a lot of fear in this market. And the thing is that as much as I'm saying all this, you're still risking. If you were to just jump short right now, I mean, you are risking that getting short in the middle of when we are going to get one of those short covering rallies. So I don't mean to sound like a broken record, but even though the markets have gotten crushed on Friday, really all last week and the week before, I've been wrong with when to expect it. What I use to look for bounces are wave counts, divergences, where sentiment is. And to me, it's telling me to expect a short covering rally rather than to look to short for if it goes lower. So that's nothing's really changed on that. Even like I said, though I've been wrong on the time part for it. We have a wave structure that's looking for a bounce. We have divergences that are looking for a bounce. We have nobody that's really expecting or is really looking to go long. So all those things are saying the short side is still dangerous, even though it's been the right side. So the bulls, we have another gap that's at 1922. This bearish or bullish wedge is just continuing, and like I said, what the risk is that you're gonna get short when they break out of it and make a run for someplace up into the the 1970 all the way up to 2000. So I'm still not comfortable shorting this market unless you're at your computer and day trading. So we have the moving average all the way up to 2014. We have a plethora of gaps up here that, again, if history is going to be our guide, these gaps get filled at some particular point. So We need to see the bulls step in. If not, then we could see a move coming someplace down to the 1850 or possibly even down to this the 1820 before a bounce hits. But again, even though that's a lot of points below, it's still dangerous to jump on the short side. So 15-minute chart. What I said that it looked like we could have made some kind of inverted head and shoulders where I had this was the left shoulder, this was the neck, and I said, this bounce right here, it wouldn't surprise me if we come and make the right shoulder and then make a bounce up. Again, it was wrong. We took out these lows, so the only other way you can now look to build some kind of inverted head and shoulders would be we get a bounce back up somewhere into the 1940 area, come down and make the right shoulder, and then come back up again. Now, I point out these inverted head and shoulders because a lot of times that is how they make the lows. They work a lot better than head and shoulders for some reason. So if the bulls can push it through the 1910 to 1928 resistance area, my guess is they're making a run to the 1943. If they start breaking through these levels, then I start expecting the 1970 all the way up to the 2033 to come into play. And again, it would still be a bearish count. So 5 minute, this is the weekly chart. Excuse me. Overall, I still believe that by the time this is all said and done, you are going to see the S&P trading down at the 1780 level. It's a lot of points, still 100 points below, but it's most likely if we get that move down here, we're going to get some bullish divergences on the weekly chart. And honestly, what it will look like is some kind of just ABC move. So I wouldn't, as much we could chop around here, but this would be, probably where a lot of buyers would be stepping in. But I don't believe it gets there, this turn here. I do believe we're going to get some chopping around, continue to make around the top. And then, once we start, getting into, more bounces and declines, by the time the year is over, people are going to be like, what happened to this market? So I'm not bullish long term at all. But I would be very careful being bearish at this particular stage because of the size of the move. So with that, that's about all I have for this weekend, and I will see you guys tomorrow. Have a great night.